Good evening.
Good evening.
So let me take this opportunity to welcome you to our today's session. I just want us to do the last part of the cost of capital. Now we are discussing about the weighted marginal cost of capital. And I remember what we were doing last time. We were discussing about the weighted marginal cost of capital, where we are discussing of the weighted average cost of capital, where we used to discuss about raising funds or looking on the existing capital structure of the organization. That is different from what we are going to be looking at today. Today, we just want to look on the what if the organization. I hope you can be able to hear me. What if now the organization is in a position to do different projects, which are different from if they want to do new projects, where are they going to be getting funds? That is the analysis which we just want to do today. So when the organization is going to be doing a new projects, it means that we have to be looking for the additional funds which are available for the organization. And that is why we are saying the WMCC is just a combined cost of raising additional new funds to be used by the firm for undertaking new projects. So the differences between the WCC and WMCC, we are saying that the WCC, it is the cost of existing funds being used to undertake existing projects, which we are calling them historical costs, whereas the WMCC is just the cost of the additional new funds for undertaking the firm's new projects, and we look on the futuristic cost. Now, when you look on the side of the another difference, we say that the WCC, it is the market value weights. The market value are used when you are calculating the WCC, but when you are going to be calculating the WMCC, we are seeing that the marginal weights are used. That is, the weights are determined from the firm's optimal capital structure. Now, in that aspect, we are also saying that the new fund shall be raised from each of the capital component based on this proportion in the optimal capital structure, so that even after undertaking the new project, the firm's capital structure does not change. And we are saying at times there may be more than one source from a given capital component, and that aspect arises for when it comes to equity. And we are saying equity may comprise ordinary share capital, retained earnings, and we are saying that in such a case, the firm shall fully utilize the amount available from a cheaper source before any additional funds can be raised from a more expensive source. Now, we are saying that when you look on the breakpoint, it normally refers to the level of financing at which amount available from a cheaper source from a given capital component is going to be utilized. So in that aspect, we're just going to be looking on the we are going to be just comparing the cost of the ordinary shares and the cost of retained earnings when you are going to be doing those computations to look on which one is cheaper and can we be in a position to utilize fully. That is what the point is talking about based on the proportions which you just need to compute. Sorry, I will be able to show you how. Now, when you look on that aspect, I just want to do some questions for a matter of understanding, so that before we reach on the operating and financial leverages, we are supposed just to be understanding and having a know-how on how we are supposed to be doing WMCC. Talk to me, Emilian.
Come again on this break point.
Sorry.
Repeat again on this break point.
The break point. The break point. A minute, please.
Yes.
So let us proceed. I was I'm just looking for the question for WMCC, and I will be able to start with some. I think we have opened from our ends. What I was looking for breakpoints, there is a student who was asking about it. When you're looking for breakpoints, it is a point where you normally find that a breakpoint is where we are going just to be using the cheaper source to utilize it fully before we look on the expensive source. And that is where we normally look on the equity aspect. Because when you look on the equity aspect, it means that it comprises of the two sources of funds. We normally look on the ordinary share capital, and also we normally have retained earnings. So there are two separate sources of funds which can be used to finance the existing to finance the new projects in which the organization is to undertake. So let me just look for a question for this, so that I will be able to explain to you in a better way when you are doing an illustration. So the question was tested on let me just check here the exact here. Just be patient. And I have not seen anyone who is sharing the assignments other than who was able to share the assignments. We shared with Emilian, was able to share with me, but I have not seen anyone else sharing the assignments which I was able to give. Is a bad indication. So let me start with the November 2017 question 3B. November 2017 question 3B. November 2017 question 3B. Who is willing to read for us? Sorry. November 2017 financial management. David Mwau, you can read for us. I can see you have unmuted. David Mwau. Taylor, can you go on? Taylor, will you read for us?
Real Properties Limited is planning to build a business mall. The project will cost 180 million shillings. The firm's current optimal capital structure is as follows. Ordinary shares, 10 shillings per value, 480,000. 10% debt, 100 shillings per value, 384,000. Retained profit, 96,000. Total 960,000. Additional information. The firm will issue a new 15% debenture at 120 shillings each with a flotation cost of 10 shillings per unit. The par value of each debenture is 100 shillings. 2. New ordinary shares will be issued at the current market price of 30 shillings each with a flotation cost of 5 shillings per share. The most recent dividend paid by the company was 5 shillings per share. 4. The dividend is expected to grow at the rate of 5% per annum in perpetuity. Okay, 5th, the firm expects to return 18 million shillings to finance these investments. 6. The corporate tax rate is 30% required. The amount to be raised from equity capital if the capital structure is to remain unchanged. 2. The number of ordinary shares the company should issue to raise the desired external equity capital.
Thank you so much. I can see we have good requirements there, which we are being required by the examiner to work on. What I can be able to see is that we were being asked about how much can we be able to raise from equity capital if the capital structure is to remain unchanged. That is one. Then number two, we are being told the number of ordinary shares the company should issue to raise the desired external equity capital. Then number three, we are being required to come up with WMCC. So I just want to show you how you are supposed to be sorting this kind of a question when they are coming in your exams. And I'll just share my board so that we can work on it very quickly. So when you're looking on our question, we are doing November 2017, question 3B. And the first thing that I just want to know, it is existing. I will just be able to analyze the optimal capital structure. I'll be able to analyze the optimal capital structure. The optimal capital structure of the organization. So what do we normally look at? We are going to be first looking on the source, right? We have to be looking on the amounts. Then we analyze the weights. We analyze the weights there. So one of the key aspects which I can be able to see in that question is we have our equity, right? And we said equity normally comprises the ordinary share capital, and then we normally have the retained earnings, correct? Now, the ordinary share capital is given differently in the question because we are being given the amount for it is 480,000 plus we have the retained profit or the retained earnings given is 96,000. We are being given as 96,000. So we need to get the summation of the two. So once you sum the two, how much are we getting? We are getting around 576,000. 576,000. I think up to that point we are together. That is what we are supposed to be getting. Once you take the combination for our ordinary share capital and retained earnings, the total should be 576,000. So we have equity and then we have debt. So what is our debt? We have been told the debt which the total debt which is financing this organization is 386,000. 384, sorry, should be 84. So what is the total? The total is already given in the question. You don't need to compute it, you just need to copy. We are getting 960. So let us look on the proportions, and that is where we are discussing about the weights to determine how much are we financing this organization using equity and how much are we financing using debt. So how am I going to be getting my weights? I will be able to take, for example, the first one for equity, we take the equity total, which is 576, you divide by the total. So it will be 576,000. You divide by 960,000. I'm getting 0.6. Then the other one will be 384 divided by 960. We are getting 0.4. These also should be giving us 1. Should be giving us 1. That is how that is the first stage which we have to be approaching our questions. Once you get that, we just need to be looking on how much do we need to raise. The amount to be raised should, as per the question, we are being told is how much. As per the question starts, we are being told the project will be able to cost us 180 million. So the amount to raise is equal to Kenyan shillings 180 million. The amount raised should be 180 million, right? So now we just need to be looking on how much should we raise from equity. And here we'll be able to say the amount to be raised from equity should be equal to, what is the proportion of the equity? And I will be able to say the proportion of equity is 0.6. So I will be able to take 0.6 times 180 million to determine the amount which you are supposed to be raising from equity. That is the purpose of calculating the weights. So I just need to take 0.6 times 180, we get 108 million. We get 108 million Kenya shillings. Now, what about the other point or the other aspect? We are looking on a, that is the amount that we're supposed to be raising. And I think it is a requirement number one. That is the requirement number one. How much are we supposed to be raising from equity? The equity can just be able to raise 108 million. What about the balance? We are going to be raising from debt, but that is not a requirement. Part two, examiner is asking us, right? The number of ordinary shares the company should issue to raise the desired external equity capital. So let us look on answering that question in this manner. We are going to be looking on the total amount raised through equity. The amount to be raised through equity should be Kenya shillings 108 million. 108 million, right? The amount to be raised through equity is 108 million. What about the amount we are raising through retained earnings? Because we know very well, this is a combination of the ordinary share capital and retained earnings. To determine the amount, to be able to determine the amount raised through the issue of ordinary shares, allow me to subtract, right? The amount which you can be able to retain, and that is under the number additional information 5, where we have been told the firm expects to retain 18 million to finance these investments. So the expected retained earning is how much? Expected retained earning. We have been told we can retain Kenya shillings 18 million. So ask yourself the amount raised, because we have been told the amount raised, through issue of ordinary shares. The amount raised through the issue of ordinary shares. How much can we be able to raise? I just need to take 108 minus 18. And we are going to be getting the amount we can be able to raise is 90 million. The amount we can be able to raise through the issue of ordinary shares is 90 million. But what is the question of the examiner? The examiner is asking the number of ordinary shares that we can be able to issue, right? That we can be able to issue through the external equity, to raise the external equity. So to get the number of ordinary shares, I'm going to be taking 90 million, right? 90 million. And then ask yourself, how much is the market price per share? And in note number 2, we have been told the new ordinary shares will be issued at the current market price of that share. So we divide by the market price per share of 30. And we are going to be getting how much? We are going to be getting 3 million ordinary shares. 3 million ordinary shares. 3 million ordinary shares. 3 million ordinary shares. That is the requirement number 2, and that is what the examiner wanted you to calculate. But when you go to number 3, I think today you'll be able to understand. Yes, Emilian?
Ngalim, what about this flotation cost in the additional information number 2?
No, we are here to reach about the issues of flotation, because here we were being asked the number. How much can we be able to issue? And I'm going to be taking the total value for ordinary share, which is the total value for ordinary share capital, which is 90 million. We divide by the market. How much can we be able to sell the securities today? But when we go to number 3, that is where we are going to be using the aspect of the flotations. When we are doing something called the component cost, because the examiner is asking component cost, because the examiner is asking you about the computation of WMCC. And I said, when you're computing the WMCC or WCC, you have to compute the component cost, right? And let me start, because we have only two, you're not going to be having a lot of work here. So I have to be looking on, are we given the expected dividends, or we are given the current dividends, or we are given the dividend which have just been paid? And in that aspect, that is where we normally draw the line to calculate the cost of equity. And the cost of equity, we are going to be guided by note number 3, where we are being told the more recent dividend paid by the company was 5 shillings per share. And this will be DO 1 plus G, you divide it by PO minus D minus F plus G. This is the time when you are calculating using the ordinary share capital. When you are using the ordinary share capital. But when we want to calculate the cost of equity using the retained earnings, we are going to be calculating by taking DO 1 plus G, you divide it by PO minus D plus G. Correct. Because we say the retained earnings are not affected by the flotation cost. That is what we discussed about. Now, I just want to compute this, and we look on the difference in proportions. So in note number 2, we are being told the new ordinary shares will be issued at a current market price of 30 with a flotation of 5 per share. Number 3, we are being told that the most recent dividend paid by the company was 5 shillings per share. Number 5, we are being given the growth rate of 5% per annum in perpetuity. But we are being told that, are we given the current, are we given DO? How much is our DO? Because I can see it is somewhere. How much is our DO? Or it is not number 3. So there is no any problem with that. So let me start by computing the cost of equity of the ordinary share capital, right? Our DO, we are being given 5. 1 plus 0.05. We divide it by the PO, we are being given as 30 minus, do we have the flotation? The discount is there, but we are being given a flotation of 5 plus 0.05. So how much are we getting here? How much can we be able to get? Let us do our computations. We have 1.05 times 5. You divide by 25 plus 0.05. We are getting around 26%. We are getting 26%. We are getting 26%. If we are calculating for the retained earnings, the cost of equity for the retained earnings, it will be 1 plus 0.05. You divide it by 30 plus 0.05. So how much is this? 1.05 times 5. You divide it by 30 plus 0.05. Getting 22.5%. Getting 22.5%. 22.5%. That is, even if you are being told to compute the breakpoint, you can see that the retained earnings are the cheaper source of finance. They are very cheaper. So we are going to be utilizing it fully. That is what you have to be checking on. We are going to be utilizing it fully. So in that case, we are going to be expounding more about the breakpoint. Now let us calculate for the debt. And when you look on the aspect of debt, we are being told that we are being given the market values and so on and so forth, but we don't have a maturity period. That is in note number 1 and note number 1. We are being told the firm will issue a new 15% debenture at 120 each with a flotation cost of 10 shillings per unit. The par value of each debenture is 100. Correct? So in this case, it means when I'm calculating that question, I have to be understanding the cost of debt. We are going to be using the irredeemable formula, which we normally take the interests. We divide by the market value minus discount minus flotation, then we adjust for taxes. So how am I going to be getting the interest? We are being told there, the 15% debenture, right? The 15% debenture with a par value. So in this case, I'm going to be taking 15% of 100. You divide by the market value. The market value we have already been given there, which we have been told is 120. We don't have a discount, but we have been given a flotation of how much? The flotation is given as 10 shillings. Then the tax rate we have been given as 0.3. So how much is the cost of debts? I will just be taking 15 divided by 110 times 0.7. We are getting 9.55. 9.55%. 9.55%. 9.55%. That is the cost of debt. That is the cost of debt. Now, from there, I just want to look at, if, for example, I'll just be able to give it with the, because I just want to utilize the available resources. And we are being told that the company expects to retain 18 million, right? You normally look on the aspect of the breakpoint because that is where we are going to be starting our question. So let us calculate the retained earnings. The retained earnings breakpoint of Kenya shillings 18 million. Kenya shillings of 18 million. So what is the question am I supposed to be posing here? I say, if 60%, that is the proportion, if 60% can give me 18 million. If I retain using the current proportion of 60%, and it is going to be giving me 18 million, you ask yourself, what if I retain fully the whole amount? How much can I get? What about 18%? How much can I retain? And it will be 100 divided by 60 times 18 million. 100 times 60 times 18 million. We see, if we are not going to be giving the ordinary shareholders their proportion, what if we tell them that we are going to be retaining the whole amount for reinvestment purposes? How much will be that amount? That is what we are looking there. So it will be 100 divided by 60 times 18 million. Then it means that one can give us 30 million Kenya shillings. It can give us a hope of 30 million. It can give us 30 million. It can give us 30 million shillings. That is what, have you understood the meaning about the breakpoints? Any question regarding the breakpoints? That is what I'm waiting for. Emilian, I'm waiting for your response, kindly.
It's okay.
It's okay. Okay. So in that regard, let me just calculate the WMCC because there is no any other source which can give us money. So you can't tell me, Mwalimu, why are we not calculating any further breakpoints? Because as per the information provided, there is no any other source which can give us breakpoints. There is no any other source which you can be able to get additional funds. Now, from that aspect, I will be able to compute first the WMCC of raising up to Kenya shillings 30 million. What is the WMCC of raising up to 30 million? Why are we taking that million and not 180 million? Because the 30 million is our minimum, which we can be able to raise. There is no any other amount which is in between 0 and 30 million, right? So we start with 30 million. Are we going to be calculating our WMCC? I will be able to tell you, to get WMCC, if all the cost of capital is available, we normally take the weight of equity, cost of equity, plus weight of preference, cost of preference, plus weight of debt, cost of debt. And because this is not available, don't stress yourself. So how much is the weight of equity? Remember, we were able to get 0.6. Then there is a student who is going to be asking, Mwalimu, are we going to be using the cost of equity of the ordinary share capital or for the retained earnings? I will be able to tell you, we normally start with the cheaper source, which is 22.5, until we utilize this source fully. So in this case, we use 22.5 plus weight of debt, which we got 0.4, times the cost of debt, which is 9.55. How much will be this amount? How much will be our weighted marginal cost of capital? How much will be our cost of capital? My calculator is telling me it's 17.32%. 17.32%. 17.32%. That is what my calculator tells me, right? Then from there, we are going now to be calculating our second WMCC of raising what? We say, let us calculate the WMCC of raising, right, above 30 million up to 180 million. What is the WMCC of raising above 30 million up to 180 million? What will be the WMCC? Why are we saying above? Because already we have utilized our retained earnings, and it means we cannot choose the cost of equity for 22.5% because it is the maximum the retained earnings can raise is 30 million. Above that, now we are going to be using the expensive source. Now, in that regard, we say, calculate our WMCC. I will take the weight of equity, 0.6, times the cost of equity, which is expensive now, which can give us additional funds, 26, plus the weight of debt, which is 0.4, times the cost of debt, which remains as 9.55. We don't have any other. So how much are we getting here? So let me just put it here. So we just say 0.6 times 26 plus 0.4 times 9.55. We get 19.42%. 19.42%. 19.42%. That is how the computation is normally done. That is how the computation is normally done for WMCC, unless we have any other question. Unless we have not understood. Unless this means we have a question, we can just be able to look on another illustration. Can we look to other illustration kindly? So if we don't have any other question, allow me to move move on. September 2015, there is another question, question 3B. September 2015. What is the reading for us now? September 2015. Let's go there. It is our pilot paper question. September 2015, question 3B. Someone to read, please. Someone reads. Yasmin, can you read for us? Hello? Rama, can you read, please?
Can you hear me? Can you hear me?
Yes, continue.
Lowilton Limited has total of 100 million shillings invested in net asset at the end of December 2014. The firm intended to increase its production capacity during the year 2015 by 100 million shilling. The company treasured debt, preferred stock, and equity capital within its capital structure. Several alternative financing arrangements are available, namely the company can issue 90% debentures with a par value of 100 shillings each at an issue price of 90 shillings cash market price. Maximum amount available is 20 million shillings. An extra debt finance will be realized through the issue of 12% debentures at 9,600 shillings each. The par value of this debenture is 1,000 shillings each. The company can issue additional 15% preference share with a par value of 50 shillings at 75 shillings each. The company can issue new ordinary shares at the current market price of 80 shillings per share. Flotation cost equal to 80 shillings per share. Shareholders have constantly enjoyed a dividend whose annual growth rate on average has been 10%, and this is expected to continue into the foreseeable future. The company's earning per share this year is 10 shillings and adopted cost dividend payout ratio of 40% each year. The company can generate 10 million shillings from the internal source to finance this expansion program. Additional information. One, the company pay corporation tax at the rate of 5%. So the firm's existing capital structure, which is considered to be optimal, is given below. Debt capital, 6% debenture capital for 10,000, 8% term loan, 20,000 and 40,000. Preferred share, 50 shillings per value, the 40,000. Ordinary share, 5 shillings per value, 15,000. Retained earning, 25,000 and 40,000. Then in total is 100,000. Required. The amount of fund to be raised from which source during the year 2015 so as to maintain the firm's existing optimal capital structure. The number of ordinary shares to be issued to raise the desired external equity. 3. The level of financing at which marginal cost of capital changes hit break point in weighted marginal cost of capital curve. Number 4, the firm is weighted the marginal cost of capital if it were to rise only shilling 20 million. 5, the firm's weighted marginal cost of capital for the fund to be raised during the year 2015 for the 3 level of financing.
Thank you so much. What I can be able to see from this illustration compared to the previous one is that we have different sources of the different sources which you can be able to use to raise additional funds. So it means when you are going to be computing the breakpoints, we are just going to be factoring additional information number 1. And also we have additional information, bullet number 1 and the bullet number 4, which are going to be assisting us to look on the amount which you can be able to raise from different sources of financing. Now, in that regard, the amount which you need to raise is 100 million, which is similar to what our capital structure looks like. So don't be carried out and understand that they are different compared to the amount we need to raise and also the existing capital structure of the organization. But the aspect of the question is that we are going to be starting from the analysis. There's is the previous question, because already I told you, in additional information number 1, by the way, we are being told the amount of funds to be raised from each source during the year 2015, so as to maintain the firm's existing optimal capital structure. And in this case, we are just going to be looking on simple things here. We are going to be looking on, because what I can be able to see there, all the three sources of finance used by the organizations are available. Now, from that case, let us give you the solution of the question. Let me give you the solution. So let me still look on the optimal capital structure. Let me give you the optimal capital structure. So how is our structure looks like? It is very simple. We are going just to be analyzing it in this manner. We are going to be having the source. We have our amount, right? We have the source, we have our amount, then we have our weights. Correct. Now, our source, we start with the equity. What is the total amount for our equity? I can see we have the ordinary share and the retained earnings totaling to 40,000. Correct. Let us look on the preference share capital. How much is our preference share capital as per the information provided? I can see we have around 30,000. Then we have our debt. Our debt, it is combined for 6% debenture and 8% term loan for 20,000, totaling to 30,000. So the total value is 100 million. So what are the weights? This one gives you 0.4, this 0.3, and also this 0.3. So let us look on the total amount raised. Total amount raised, we have been told is Kenya shillings 100 million. The 100 million. So let us look on the amount raised from we start with debt. Debt, you are going to be raising how much? You just take the proportion or the weight, 0.3, you multiply by the amount you need to raise, 100 million, giving you that million, right? We have the amount raised from the preference, 0.3 times 100 million, which we get 30 million. And also the amount raised from equity will be 0.4 times 100 million, getting 40 million. That is what we are being asked there. The amount to be raised from each source, and that is what we were expected to do. When you look on the requirement number 2, we are being also asked about the number of ordinary shares which can be issued. And in this case, we are just going to be taking the total amount from equity. The total amount from equity, we are being given Kenya shillings 40 million. The total amount which we can be able to raise from equity is 40 million. But how much can we be able to raise from the retained earnings? Then the bulletin number 4, it tells us that the company can generate 10 million shillings from the internal sources to finance this expansion program. Then we are going to be lessing here. Let the expected retained earning. The expected retained earning is how much? Kenya shillings here, 10 million. Right? So let us look on the amount to be raised from ordinary shares. From the issue of ordinary shares, we can just be able to raise 30 million. When we issue we issue the ordinary shares to the public for subscription. But what about the number of ordinary shares? The number of ordinary shares, we are just going to be taking the number of ordinary shares we are going to be taking, the total amount which you can be able to raise, we have 30 million, then we divide it by what? We divide it by the market price per share, and in note number, let me look at it there. We have been told in bullet number 3, the company can issue new ordinary shares at the current market price of 88 shillings. So how much is the number of ordinary shares? 30 million divided by 88. 30 million divided by 88 shillings. And you're going to be getting 340,909 shares. 340,909 shares. Those are the only shares we can be able to issue to the public for subscription. Now, now the requirement number 4, the requirement number 3, we have been told the level of financing at which marginal cost of capital changes at breakpoints, and that is the area we should be enjoying so much. So let us calculate the breakpoint. And we have 2 points which we can be able to raise additional funds. One, we are being told in bullet number 1, the company can issue 9% debenture with a par value of 100 shillings each at an issue price of 90, the market price. The maximum available we can get is 20 million. You ask yourself, the proportion for the debt is 30%. So you ask if 30% can give us Kenya shillings 20 million. What if we utilize this source of finance fully, 100%? How much can it give us if you utilize it fully? And I say it will be 100 divided by 30 times 20 million. How much are we going to be getting? Right? It will be 100 divided by 30 times 20 million. We are getting Kenya shillings 66,666,667. 66,666,667. That is the amount we can be able to raise if we utilize the 9% debenture. The 9% debenture. If we utilize it fully, this is how much it can give us. What about the retained earnings? Number 2, we are discussing about the retained earnings. And when you look on the retained earnings, we are saying, as per the last bullet, it has told us that we can be able to raise the 10 million. You ask yourself, if 40% can give you 10 million, what about 100%? If it is fully utilized, this source can give us how much? We say it is 100 over 40 times 10 million. So 100 divided by 40, right, times 10 million. We are getting Kenya shillings 25 million. We are getting 25 million. That is the aspect of the breakpoints as required by the examiner. How much can we be able to raise? I told you the first one we were being told we can be able to issue to get a 9% debenture. A 9% debenture can give us 66 million. This one can give you the maximum of 25 million. Let us look on the requirement number 4. The firm's weighted marginal cost of capital, if we were to raise only 20 million Kenya shillings. 20 million Kenya shillings. And where is the 20 million coming from? We have been told the maximum available is 20. Any extra debt finance will be raised through the issue of the 12% debentures at 960 shillings each. So that being said and done, I will just be able to start by computing. That is a requirement number 4. We compute our component costs. The component cost, I'm going to be starting with the cost of equity of the ordinary share capital, DO 1 plus G divided by PO, discount and flotation plus G. So how much is our DO? How much is our DO? So we have been told in bullet number 3, the company can issue new ordinary shares at the current market price of 88. Flotation cost equal to 8 shillings sold. The company ordinary share has consistently enjoyed a dividend whose annual growth rate is 10%. And we have been told we are expecting that in the foreseeable future. But also the company earning per share. I told you when the DPS is not provided, you don't need to panic, because take your earning per share, you multiply by payout ratio. So how much is our earning per share? That information is provided there. We have been told the earning per share this year is 10 shillings. And we adopt a 40%. This equals to 4 shillings. They equal to 4 shillings. So I take 4, 1 plus, how much is our growth rate? We have been told that we are growing at 0.1. You divide by 88, which is the market price per share, minus our flotation cost, which we have been given as how much? 8 shillings plus 0.1. How much is this? 1.1 times 4 divided by 80 plus 0.1. We are getting 15.5%. 15.5%. 15.5%. What about the cost of equity of the retained earnings? You're just going to be taking DO 1 plus G divided by PO because we don't have a discount plus our growth rates. So I just copy there. It will be 1.1 divided by 88 plus 0.1. How much would be this one? 4.4 divided by 88 plus 0.1, getting 15%. 15%. So it means the cheapest source of ours is the retained earnings. The retained earnings becomes the cheapest source of finance. From there, we need to go to the next one. We need to proceed to the next one. The next one now we go to the cost of preference shares. Let me just follow that route. So let us do the preference share. The preference share capital. So to get our KP, we said, take your preference dividends, divide by the market value minus discount minus flotation times 100%. That is what we said. How much is our preference dividends? We were being told in bullet number 2, the company can issue additional 15% preference shares at a par value of 50 at 75. So it will be 15% of 50 divided by the market value is how much? How much is the market value? We are being told that the market value of ours is 75 times 100%. Times 100%. So 0.15 times 50 divided by 75. We are going to be getting how much? Someone can tell me is 10%. This one is 10%. Then we go to the last one, not the second last, because we have different sources. One, we look on the cost of debt, and I have not seen the number of years. So we use the irredeemable, the interest, divide by the market value, discount minus flotation, 1 minus T. Correct? So what am I going to be doing here? I can see we have two kind of debt sources. So the first one will be how much? The first case will be the 9% debenture. And you know, the 9% debenture can be able to raise 66.667 million. Correct? That is what we need to understand. So the 9% we are being told, to get our KD for the 9%, we are going to be taking what? What is our interest? We are being told the company can issue 9% debenture with a par value of 100. So it will be 9% of 100. We divide by how much is the market price for that debenture, which we are being told. Each has an issue price of 90. This is the market price per share. Then we adjust for tax, 1 minus 0.3. How much is this? It will be 9 divided by 90 times 0.7. And we are getting 7%. You're getting 7%. That is one. Then the second one, you're being told also we can use 12% debenture. The 12% will be how much? We are being told for 12%, as you continue that bullet number 1, we are being told any extra debt finance will be raised through the issue of 12% debenture at 960 each. The par value is 1,000. So it will be 12% times 1,000 divided by 960. Then adjust for taxes, 0.3. So this is how much. That one is how much. It will be 0.12 times 1,000 divided by 960 times 0.7. We are getting 8.75. 8.75. There is a question you students normally ask. Mwalimu, where am I going to be starting my computation? I remember the minimum, because the examiner is talking about 20 million, and the cheaper source is 15. The cheaper source is 15%. It will be the same if I do the WMCC of raising up to 25 million, because it will be the same even if you raise the 20 million. Because the cheapest source of our finance is 15. When you raise the 20 million, right? If you raise the 20 million, you are going just to be using the retained earnings. When you're going to be raising the 25 million, you'll also be able to use 15%. There is no any change in your WMCC. So allow me just to use for the 25%, and I will be able at 25 million, I will just be able to say, to get my WMCC, I will be able to take the weight of equity. And the weight of equity of ours, we were able to get how much? I think it was 0.4 times 15% or 15, which is the cost of equity, the cost of equity of the cheaper source, plus the weight of preference, 0.3, times the cost of the preference, we were able to get 10, plus the cost of the weight of debt is 0.3 times the costs. When you look on the cheaper between the two, it is 7%. Until you exhaust 66.67 million, the 7% still prevail. So here we put 7. Until we exhaust this one, then we are going to be shifting to the expensive debenture. So in this case, it will be 0.4 times 15 plus 0.3 times 10 plus 0.3 times 7. We are getting 11.1%. Once you finish that, because that is one, we calculate also the WMCC of raising above 25 million up to the other amount which we can be able to reach is 66.67 million, right? Above 25 million up to 66.67 million. 66.6 million as 0.67 million. So if that is above 25 million, it means the retained earning cannot be able to raise additional funds. They cannot. So in this case, I say to get my WMCC, I will use the weight of debt of equity 0.4. But the cost now I will not be able to use 15. I use the expensive 15.5 plus the weight of preference 0.3 times 10. This remains 0.3 times 7. So how much is this? 0.4 times 15.5 plus 0.3 times 10 plus 0.3 times 7. Here we get 11.3%. We get 11.3%. Do we still have any other? You say yes. You say yes. Why? Because when you look on your debenture, the cheaper debenture has already been exhausted, because the much it could have raised is 66.67 million. So where am I going to be getting the extra amount? Because I have not raised enough. I say, let us calculate the WMCC of raising above 66.67 million up to 100 million. Up to 100 million. Where am I going to be getting this? I say, to get that WMCC, the weight of equity is 0.4. The expensive source is 15.5. The weight of preference remains, correct? Then plus the weight of debt now, it will be 0.3, but we multiply now with the expensive debt of 8.75 to assist us get more funds. In that case, it will be 0.4 times 15.5 plus 0.3 times 10 plus 0.3 times 8.775. This one we are getting 11.83%. 11.83%. 11.83%. Anyone who has not understood the concept? Anyone? Anyone who has not understood the concepts? So if the concept is clear, let us finalize the last part of our topic. And in this case, I just want to look at the operating and financial leverages. Let's look on the note first. And we have been told that the operating and financial leverage, the leverage refers to the effect of financing and operating costs to the profit of the company. In measuring leverage, three models are normally used or are available. One, we normally use the degree of operating leverages, right? Two, the degree of financing leverages. Then the three one, we normally use the degree of total or combined leverage. So let us start with the DOL, and we are saying to measure the effect of the operating cost to the profits of the company by comparing the contribution with operating profits. So they are the DOL, the model risk, and you can be able to see there, what are you supposed to be taking? You just need to take the contribution. You divide by EBIT. Now, when you look on the degree of financial leverage, the DFL, we are saying it measures the effect of finance cost or interest to the profits of the firm. They are the DFL, they are the risk. So the DFL, we normally take the earning before interest and taxes. We divide by the earning before taxes. The last one is the degree of the total so combined leverages, and we are saying to measure the effect of the total cost, both operating and finance cost to the profit of the firm by combining both the DFL and DOL. So they are the DTL, the higher the risk. So let us look on any question which was tested from, I think you can be able to hear me. There is no any effects on my network. So let us look at any question which was a setup of a question from these points. So there is a question, yes, in this one I cannot be able to do now because I think we don't have. There is a question in May 2015. I'll just be able to do it later on because I don't have the question now. I'll just be able to type it and then I will be in a position to share with you guys so that we can just be able to do it. So you can be able to remind me on Saturday because you're going to be having our class, yeah? But I will be able to request you to go through the notes for the ratios because I will not be able to pass through all of them. There is a lot of notes there regarding the ratio, the financial analysis and forecasting. Just read those notes because I will just be able to come and do illustrations. I just do illustrations in that topic because it's a topic which already talks much about, it is a topic full of formulas. So don't expect me to just come and take you through. You can just be able to write your formulas, and from there, you'll be in a position to understand more because I'll just be able to consider doing a lot of illustrations. Any question?